Leverage, good or bad? That's the subject of today's video. What we're going to do is, in the context of hedge funds deleveraging, which sounds like a bad thing, we're going to take a look at what leverage actually is, how people get into debt, the other word for leverage being gearing or indebtedness, and how investors can use that to their advantage. We'll take a look at property, we'll take a look at investment trusts, a favourite of Money Week, and we'll take a quick look at a spread bet on gold. So, three areas where leverage can work to your advantage, but be warned. The idea of hedge funds deleveraging, that's panicking and selling assets and trying to pay off debt, suggests that it can all backfire too. So, let's call it three ways that leverage can boost or seriously destroy your wealth. So, as long as you know what you're doing with leverage, it can work to your advantage, but be careful. Plenty of people who are in debt would regret that decision right now. Okay, so let's get straight in there. As a property investor, for example, or just buying your own home, is leverage a good thing? Now, a lot of people have to take out a mortgage because they've got no choice. But if you had a choice between putting down a big deposit and taking out a big mortgage, is there a straight answer as to which works best? And the answer is no, actually. All depends. In a bull market, leverage is fantastic. It enhances, accelerates returns, it's like magic. But in a bear market, when prices are falling, it's your worst enemy, or can be. So let's take a quick look. Now I'm going to keep the numbers very simple here. So let's imagine we're looking to buy a house, just to get the basic example out here. And by the way, it is amazing how many people in financial markets do not really understand leverage. So it's one of those concepts that you really need to get your head around, I think, if you're going to play with debt. So you're looking to buy a house. Now let's say there are two of you, really boring, I'm going to call them A and B, both looking at houses, identical houses in the same street next door to each other. So the price, £200,000. So both of you buy identical new build houses for £200,000. Here's the difference, the funding. Now, basically, the first buyer has loads of cash and decides to put £200,000 in. Lucky them, they can just pay the asking price in cash. Another word for that is equity. You immediately have £200,000 of equity in the property because you've just bought it outright. It's yours. Now, buyer B, who's buying next door, in the same street, in the same suburb, isn't quite as well off. So he puts down a £100,000 deposit, not bad, 50%, can't argue with that, and then takes out a loan, or a mortgage as we call it, for the remaining £100,000. So of course, you've still got to find £200,000 to buy the property, it's just a question of how. And buyer B goes for a £100,000 deposit and a £100,000 loan. Now so far you might say, so what? They can both move in, they've both got the keys, they can both live there, with B repaying the mortgage over however long it takes. Is there a difference between these two from an investment point of view and a kind of return on investment point of view? Yes, there is. Let's take an extreme case in a bull market. Let's say the value of these properties quickly rises. So let's say even just a couple of years later, the value of the house in both cases, because they're identical houses, has rocketed up to 300,000. Now imagine, ignoring transaction costs, estate agents and all that kind of malarkey for this example, now imagine both sellers, or both buyers, decide to sell. They can't stand living next door to each other, so they both dump their properties at the same time. Now, over here, you pay £200,000 for a house, you're selling it for £300,000. Easy maths. Basically, you have made yourself a profit of £100,000. So, over here, nice little profit of £100,000 ignoring transaction costs. In other words, you've turned £200,000 that was invested in a house into £300,000 by selling it. Over here, what's the situation? House is worth 300, so let's sell it. Let's assume we're still carrying a loan, a mortgage on it of £100,000. Okay, so basically, you sell the house, you repay the loan of £100,000, So the difference between the value of the property and the value of the loan is £200,000. Now, point is this. Over here, this is the better strategy. This is leveraged investing in property, and the result is this. Having put £100,000 in, you're taking £200,000 out. Over here, having put £200,000 in, you're taking £300,000 out. And in percentage profit terms, this is the better return on investment. Turning 100,000 into 200,000, or doubling your money, is better than adding 100,000 to 200,000, or adding 50%. And that's purely a function of leverage or debt. So mortgages can actually increase the rate at which you make money in a bull market. And you might be thinking, well, in that case, the next time I buy a house, I'll gear myself up to the eyeballs. I'll go for a 95% mortgage. Two problems with that. Number one, you probably can't get one because the banks aren't lending like that at the moment. But more fundamentally, even if they were, you wouldn't want to do it. And that's because, in reverse, leverage is a nightmare. Okay, what do I mean by that? Well, let's just maybe skip back quickly to these numbers. And let's say the original property, rather than going up in value, plummets. Okay, so we'll keep the facts as they were at the start of the example. So what do I mean by that? What I mean is we started off with a £200,000 house, funded 100% with cash here and 50% with debt over here. But now let's imagine that a year later the price of the property hasn't increased, it's dropped. Let's imagine we're in a bear market. Well, we don't have to imagine that, we are in the UK. Let's imagine that the value of the house you're living in plummets to £100,000. And right now, this is the more likely scenario, you might say. Okay, so you've really had a nightmare. These buyers have bought in the wrong suburb and basically prices have collapsed and they hate each other, so they still want to sell. All right, now try selling now, assuming you can find anyone to buy the house. Okay, basically position is this. Buyer A sells the house for £100,000. That unfortunately has wiped out 50% of the cash they had in the property. Because don't remember, they owned the whole property, so they'll get the selling price back in cash. That's still half what they put in. That's life. You buy an asset for 200, goes down to 100, you lose half your money. Over here, that's bad, but over here, basically, poor old buyer B's got a much bigger problem. Sell the house for 100,000, you've got to pay the mortgage off, all right? You can't just leave the bank loan outstanding for 100 grand. Clearing the loan reduces this to zero. In other words, all you can do is clear the loan. Your £100,000 deposit is gone. That's 100% of your initial investment. So that's an illustration of what gearing can do on the flip side. Get it wrong and it wipes out your money a lot quicker. Now, property was investment number one. Investment number two we can do very quickly. Investment trust companies. At Money Week, we like them. I've done a video on why we like investment trusts, so I'm not going to explain the whole concept here. But in essence, when you hear us talking about why we like investment trusts as investment vehicles, that's companies that buy shares in other companies, rather than unit trusts, which are sort of a big part of the industry called mutuals in the States and often advertised and marketed hard, one of the answers is gearing. Investment trusts are able to borrow. In other words, I could do a very similar example like this, where buyer B is an investment trust and buyer A is a unit trust, if you like, and you get a similar conclusion. The ability to gear up, which investment trust companies have, can accentuate returns if the directors get it right. Word of caution would always be using a sort of Morningstar or a TrustNet website, for example. Check the level of gearing, it's called gearing often, in an investment trust company before buying, just to make sure it's not suicidally high. Because if it's really high, you do risk, if the market falls, a scenario like buyer B for property. Okay, so basically what we're saying is property investment can be enhanced with leverage, but you want to be careful right now. Investment trusts can use leverage to their advantage, but always check how much they're using. And the third area where leverage plays right into your hands but can also be catastrophic is spread betting. So let's take a quick look at my third investment that uses leverage, spread betting. And why not pick a topic that's all over the newspapers at the moment, the gold price. Gold's gone crazy. Basically, we have plenty of Money morning emails at Money Week which explain Dominic Frisby what's going on there and what you should do. But one option would be a spread bet. I'm just going to use that to illustrate leverage. That's all I'm going to do this morning. I'm not going to say buy or sell, just how the leverage side of things would work. Okay, so a gold spread bet might look something like this as my third investment. I'm going to keep the numbers very, very simple here. I'm going to ignore bid to offer spreads just to give you the basic flavour as to why spread betting can be fantastic or can be a bit of a disaster. It depends on how you use the fact it's leverage. Leverage being you get a lot of bang for your buck. That's what it really means. So take a very quick example. Let's say you could buy gold using a spread bet at, I'm going to create a price here of, let's say 1,580. Now the gold price recently broke $1,600 per ounce, it's just over £1,000. So let's say the spread bet price you're being offered is 1,580. So you open a spread betting position, $1,580. Now, in reality, it might be 1,580.3 or 0.7. Okay, but let's say it's 1,580 dead, and you open your position. The gold price rises, let's say, and gets back to $1,600 an ounce. By the way, for anyone who thinks this is a little quick, I have made two other videos, one on what spread betting is all about and another one on why you should do it. So have a look at those if you're getting lost. But let's say the gold price rises to $1,600 and I decide to close my position by selling out of it at the new higher price. So my profit, and again it could be 1,600.7 or 0.75, let's say it's 1,600 dead. So in profit terms you'd think, well, that's the difference between $1,600 and 1,580. So that's a $20 profit. But this is the point about spread betting. Okay, this would be the profit you make off an ounce of gold. But that's not how spread betting works. Spread betting gives you exposure to a lot more. And that's because with a gold spread bet, you're actually betting per 0.1 dollar movement in the gold price. So what that means in effect is, yeah, there's a $20 profit here, but expressed as a number of 0.1s of a dollar or tenths of a dollar, if you want to see it that way. That's a 200 point profit. To a spread better, as a 200 point profit. And if I was betting at, say, £10 per point, that would give me a £2,000 sterling profit off a very small upfront deposit. My broker might only charge me a percentage of my total exposure, and I've made a £2,000 profit. So off a $20 move in the gold price, a spread better could make quite a serious profit or loss if the price drops. So advice for spread bettors: put in stop losses and talk to your broker if you're not sure what those are, or see my video on spread betting.